Welcome to Module 3. We'll explore the time value of money in mortgage lending. This concept is crucial because it shows us how the value of dollars today impacts loan payments, borrowing choices, and ultimately, the long-term value of real estate. Essentially, this module is about understanding how financing decisions and property value interact over time, forming the foundation of mortgage loans. Let's dive into these principles to build a solid understanding of how money's worth changes and influences real estate finance. Let's talk about the time value of money. Simply put, a dollar you have today is worth more than that same dollar in the future. Why? Because money you have right now can be put to work. It can be invested to earn interest, or it can help you avoid borrowing costs down the line. This principle is especially important when it comes to mortgage lending. The timing of your payments and loans can significantly impact their value, and ultimately, your decisions in real estate over the long term. Understanding this foundation is key to making smart financial choices with mortgages. Let's talk about why the time value of money, or TVM, is so important in mortgage lending. A mortgage isn't simply the amount of money you borrow. It represents money that's priced over time. This means when you take out a loan, the timing of payments affects what each payment is actually worth. Interest plays a key role here because it determines how the cost of borrowing accumulates throughout the years. Understanding present value helps you compare different mortgage options by showing what future payments are worth in today's dollars. On the other hand, future value links your current financing decisions to the long-term returns you can expect. These concepts form the foundation of mortgage loans and are essential for making informed borrowing decisions. When we look at the borrower's perspective on getting a loan today, it's really about turning future income into immediate buying power. Instead of waiting years to save the full price of a home, a mortgage allows borrowers to access a home right now. This means they can move into the property as soon as the need or opportunity arises. One key benefit is that the large cost of buying a home is spread out into manageable monthly payments. This makes it easier for borrowers to handle the financial commitment over time rather than all at once. Another important aspect is building ownership. With each payment, borrowers gradually increase their equity, gaining more control and value in the property. Essentially, a mortgage doesn't just buy property, it buys time. It offers immediate access to housing in exchange for the promise to make future payments. This balance between present access and future cash flows is what makes mortgages such a powerful financial tool for buyers today. When a lender issues a mortgage, they're essentially trading cash now for a larger stream of payments over time. From the lender's perspective, repayment happens gradually, typically over many years. This repaid amount includes both the principal and interest, with interest serving as a lender's compensation for time, risk, and the fact that they can't use those funds elsewhere during the loan period. Monthly payments provide the lender with predictable cash flow throughout the life of the loan, which helps them manage their finances and expectations. Early on, these payments are weighted heavily toward interest, meaning the principal balance declines more slowly at first. As time goes on, more of each payment reduces the principal. One key point to remember is that the longer the repayment period, the more total interest the lender earns. This is why understanding how payments break down over time is crucial to grasping the lender's position in a mortgage loan. Let's take a closer look at the concepts of present value and future value, which are fundamental in understanding mortgage loans. Present value refers to what future money is worth today. It's a way to analyze whether the price of a loan or investment right now makes sense compared to what you'll receive later. Essentially, it allows us to judge the fairness of today's cost. On the other hand, future value represents what the money you have today can grow into over time. It highlights the long-term results of payments, appreciation, and reinvestment, showing the potential growth of your investment or loan payments. Understanding these two concepts is key to making informed decisions about mortgages and investments. Here we're focusing on calculating present value, which is a fundamental concept in finance. The core formula you'll see is PV equals FV divided by 1 plus R raised to the power of N. PV stands for present value, which means what a future amount of money is worth in today's terms. FV is the future value, or the amount you expect to receive or pay later on. The letter R represents the discount rate per period, This reflects the required return or the cost of money over time. Finally, N is a number of periods until the cash flow happens. To put it simply, if a lender expects to get $10,000 5 years from now, the present value calculation helps determine how much that future payment is worth today, taking into account the time value of money. This is especially useful in mortgages, where it allows borrowers and lenders to compare loan payments and financing options on a consistent and fair basis. Understanding this helps make smarter financial decisions when dealing with loans and investments. Here, we're focusing on calculating the future value of an investment or loan. The core formula is FV equals PV times 1 plus R raised to the power of N. FV stands for future value, which is the amount your money will grow to after the growth period. PV is the present value, or the amount you start with today. The R represents the interest rate earned each compounding period, and N is the total number of those compounding periods. For example, if you invest $10,000 at a 5% annual interest rate for 3 years, the future value would be around $11,576. This calculation is really helpful for both borrowers and investors because it gives a clear picture of how money grows over time, which inform decisions on purchases, refinancing, or investments. Here, we're looking at an example of how to evaluate a mortgage offer using present value calculations. The key idea is to discount the future payments back to today to determine what that stream of payments is worth right now. In this example, the monthly mortgage payment is $1,950, and the term is 360 months, which is 30 years. The monthly discount rate used here is 0.5%, which represents a required annual return of 6%. To find the present value, we apply the formula for the present value of an annuity, the payment amount multiplied by the annuity factor. The annuity factor, in this case, is 166.8. When you multiply the $1,950 monthly payment by that factor, you get a present value of approximately $325,260. This means that the loan amount is around $325,000. The mortgage is fairly priced to meet the lender's target return of 6%. If the loan amount were higher than this present value, the mortgage offer would be less attractive to the lender because the value is lower than needed to hit that return. Conversely, a lower loan amount improves the value from the lender's perspective. So, this present value calculation is crucial in assessing whether the mortgage terms align with the lender's required return. Here we have a practical example illustrating the power of long-term investment growth through the concept of future value. Imagine an investor puts $25,000 into a real estate fund that earns a steady 6% annual return. If they keep this money invested for 15 years without withdrawing, the investment will grow significantly. We use the future value formula, which is the present value multiplied by 1 plus the interest rate, raised to the power of the number of years. Here, that looks like $25,000 times 1.06 raised to the 15th power. Calculating the growth factor, 1.06 to the power of 15 equals approximately 2.3966. Multiplying $25,000 by this growth factor, we get a future value close to $59,915. This means the initial investment more than doubles over 15 years due to compound interest. The key takeaway is that time and consistent returns combine to dramatically increase wealth, which is why patience and long-term planning are crucial in real estate investing. When we talk about loan amortization, we're referring to how each mortgage payment is divided between two key parts, the interest you owe and the principal you repay. This process gradually reduces your loan balance over time. A single monthly payment essentially has two jobs. First, it pays the interest, which is the cost of borrowing the money. Second, it pays down the principal, which is the actual amount you borrowed and still owe. Now, the way these two parts split changes throughout the life of the loan. Early on, most of your payment goes towards interest because the loan balance is higher. As time goes on and the balance decreases, a larger portion of each payment goes toward principal. This shift helps you build equity faster as the loan progresses. Understanding this breakdown is fundamental to grasping how mortgage loans work. Here we're looking at how a fixed-rate 30-year mortgage amortizes over time. At the beginning, you'll notice that most of your payment goes toward interest rather than reducing the principal. This is why the interest portion starts out high, although the total payment amount stays the same each month. The composition of that payment gradually shifts. More and more goes toward paying down the principal as the interest portion declines. Because of this shift, the balance on your loan decreases slowly at first, then more rapidly as you near the end of the term. The schedule here shows specific examples. Early payments consist of about $299 in interest and $1,500 toward principal, with the remaining balance just slightly lower. Near the end, almost all the $1,799 payment goes toward principal, with interest dropping to single digits, causing the balance to accelerate toward zero. This pattern is typical in mortgage loans, and it's important to understand because it explains why paying extra early on can save significant interest costs over the life of the loan. It also highlights why, with a fixed-rate mortgage, your consistent monthly payment is split differently over time, but your loan will be fully paid off after 30 years. Let's talk about how interest compounds over time and why that's so important. Compound interest means that you earn or pay interest not just on your original amount, but also on the interest that's been added previously. This effect becomes much more noticeable the longer your mortgage or investment lasts. At 5 years, you start to see some interest build up, but the total growth is still relatively small. By 10 years, more of the growth comes from the interest that was already added in previous periods, which means your money or your debt is beginning to grow faster. By 15 years, compounding really kicks in, and the balances or total returns start to grow much more quickly. And at 30 years, time has done most of the heavy lifting. The cumulative interest can become the biggest part of your total growth or total cost. So, the key takeaway is that time is a powerful factor when it comes to compounding. Whether you're building wealth or paying off a mortgage, the longer the time frame, the bigger the impact of compound interest. On this slide, we're focusing on how interest rates impact the total cost of a mortgage loan over time. Even a small increase in the interest rate can add up to hundreds of thousands of dollars in total borrowing costs. To illustrate this, let's consider a $300,000 mortgage with a 30-year fixed term, keeping the loan amount and duration the same for comparison. At a lower interest rate of 3%, your monthly payment would be around $1,265, and over the full 30 years, you'd pay about $155,331 in total interest. This represents slower growth in the overall cost of borrowing. Now, if the rate jumps to 5%, which might seem like a moderate increase, the monthly payment rises to $1,610. More importantly, the total interest paid over the life of the loan balloons to nearly $279,767. That's over $124,000 more than the 3% loan. At an even higher rate of 7%, the monthly payment jumps to $1,996, and the total interest paid skyrockets to $418,528. This amount is almost 2.7 times the interest paid at the 3% rate. This comparison clearly shows how sensitive your total borrowing cost is to interest rates. Even small changes can have a huge impact on your financial obligations throughout the life of the mortgage. So it's crucial to understand and consider these differences when shopping for a loan. When we talk about real estate investment valuation, one of the most important concepts to understand is the time value of money. This principle helps investors determine if a property's future cash flows are actually worth the price paid today. It's not just about looking at the expected rent or resale proceeds in isolation. You need to consider financing costs and the holding period as well. All of these factors have to be translated into present value to make any meaningful comparison between different investment opportunities. What's really key here is that value depends on both the amount of money and the timing of those cash flows. Future income streams only matter when they are measured against today's dollars. So, a property that seems profitable in nominal terms might actually create less value once you factor in the timing and discounts. The time value of money transforms real estate analysis from simply checking prices into making a true, informed investment decision. Understanding this ensures that you're not just chasing numbers, but making choices that maximize value over time. Here we're looking at how rental income, expenses, and net returns evolve over the first 4 years of an investment. In year 1, The rental income is $24,000, with expenses and debt totaling $19,000, leaving a net return of $5,000. Moving to year 2, rental income increases slightly to $25,000, while expenses remain steady at $19,000, boosting the net return to $6,000. Year 3 follows the same pattern. Rental income rises to $26,000. Expenses are still $19,000, and net returns grow to $7,000. By year 4, the rental income reaches $27,000, with a slight increase in expenses to $20,000, but net returns remain steady at $7,000. The key takeaway is that even modest annual cash flow becomes significantly more valuable when it persists over the entire holding period. Steady, positive, and predictable cash flow that grows over time lays a solid foundation for long-term investment returns. This illustrates how consistent rental income, controlled expenses, and manageable debt contribute to building wealth through real estate investments. Let's take a closer look at discounted cash flow, or DCF, analysis. This method helps us estimate the current value of a property by converting all its future cash flows into present-day dollars. First, we project the property's future rental income, operating expenses, and any proceeds from selling the property down the line. Next, we select a discount rate. This rate reflects the return we expect, as well as factors like inflation and the risk associated with the investment. Once we have our future cash flows and discount rate, we discount each of these cash flows back to their present value. Finally, we add up all these present values to get an estimate of what the property is worth right now. The key takeaway here is that if this estimated value is higher than the purchase price, it signals that the deal might be a good buy. Essentially, DCF analysis gives us a clear, numbers-driven way to decide whether to move forward with an investment or pass on it. Let's talk about the discount rate, which you can think of as the price of time. Essentially, it's a way to convert future dollars into their value today. This is crucial because money available now is worth more than the same amount in the future due to several factors. First, there's inflation. Inflation means that tomorrow's money will buy less than money today, so we need to account for that decrease in purchasing power. Second, there's risk. Since future cash flows are uncertain and not guaranteed, we value them less today to reflect that uncertainty. Lastly, we consider opportunity cost. Money invested in one place needs to outperform other possible investments, so the discount rate must reflect the returns you'd expect elsewhere. Understanding these elements helps us grasp how mortgage loans and other financial decisions are grounded in the concept of discounting future values to present. Here we are comparing 3 investment options using the concept of time value of money, or TVM. The first option, Property A, has a purchase price of $280,000 with an expected return of 7.2% over a 10-year time horizon, resulting in a net present value, or NPV, of $24,000. Property B, on the other hand, is priced at $325,000, but offers a higher expected return of 8% over a longer period of 12 years, and its NPV is $39,000. Lastly, Property C costs $260,000 with a 6.5% expected return over 8 years and an NPV of $18,000. What stands out here is that Property B creates the strongest value, as it delivers the highest net present value, meaning it offers the best return after adjusting future cash flows for the time value of money. Therefore, based on this analysis, Property B is the best choice from a TVM perspective. Inflation plays a crucial role in mortgage decisions because it directly affects the real value of future payments. When inflation rises, the dollars you pay in the future are actually worth less in terms of purchasing power. This means that a fixed mortgage payment can feel less expensive over time as both prices and incomes increase. For borrowers, this inflation effect can make locking in a long-term fixed-rate mortgage very appealing, especially if inflation is expected to remain high. It provides a sense of certainty and can actually reduce the real cost of their debt as inflation erodes the value of fixed payments. On the other hand, lenders and investors need to be mindful of inflation's impact from a different angle. Inflation increases the importance of earning returns that surpass the loss in purchasing power. Essentially, they want their investment returns to outpace inflation to preserve, and ideally grow, the real value of the money they lend. So, When making mortgage decisions, it's critical to look beyond the nominal interest rate stated on the loan. Instead, you should consider the real cost of debt after accounting for inflation. This perspective leads to stronger, more informed decisions because it reflects the true economic impact over the life of the mortgage. Let's dive into Module 3, which focuses on risk, uncertainty, and the time value of money. First, when we talk about risk, it's important to understand that higher risk makes future cash flows less certain. Because of this uncertainty, lenders and investors expect a higher return today to compensate for taking on that risk. Next, uncertainty involves factors like interest rates, inflation, property values, and borrower behavior. These variables can change over time, making it challenging to predict long-term financial outcomes with precision. Now, how does this affect the time value of money? Essentially, the greater the uncertainty about a future payment, the lower its present value. This means that when we're valuing future cash flows, we have to adjust for both risk and uncertainty to get an accurate picture of their worth today. Understanding this concept is crucial in mortgage loan foundations and financial decision-making overall. Here we're comparing two main approaches to managing a mortgage: paying off a loan early versus sticking with the standard loan term. First, by paying off your mortgage early, you reduce the total interest paid over the life of the loan, which means you save money in the long run. Another benefit is that you build equity faster, giving you more ownership of your home sooner. Plus, the guaranteed return you get from paying down the loan early is essentially equal to your mortgage interest rate, which is a solid, risk-free return. On the downside, paying off early ties up your cash, leaving less available for other investments or expenses. On the other hand, sticking with a standard loan term means you'll pay more interest overall. However, it frees up your cash flow, allowing you more liquidity and flexibility. That money can be invested elsewhere, potentially earning a higher return, which might outweigh the extra interest paid on a mortgage. But remember, your debt lasts longer, so you have that obligation hanging around. Ultimately, the best choice depends on your personal financial situation and goals. It comes down to whether saving on interest costs or leveraging your cash for potentially greater returns over time creates more value for you. Here we have three fundamental formulas that are essential for understanding mortgage cash flows over time. First is the present value formula, which helps us determine the current worth of a future amount of money by discounting it back at a certain rate. This concept is crucial because it allows us to see how much a future payment or loan balance is really worth today. Next is the future value formula, which projects how an amount of money grows as it compounds over multiple periods. This helps us understand how loan balances increase with interest over time if payments are not made. Finally, the loan payment formula calculates the steady, level payment needed to completely pay off a loan over a specified number of payments. It takes into account the principal, interest rate, and total number of payments to give a precise monthly or periodic payment amount. Together, these formulas connect today's loan amount, its value in the future, and the payment required each period to bridge that gap, which is fundamental in mortgage valuation and repayment planning. Let's go over some common mistakes that can trip us up when analyzing the time value of money. First, ignoring the compounding frequency can really distort your calculations. For example, using a monthly rate instead of an annual rate, or vice versa, won't give you the same result. So it's important to be consistent and accurate with how often interest compounds. Second, comparing cash flows from different points in time without properly discounting them can lead to misleading conclusions. Dollars today are worth more than dollars in the future, so you always need to adjust for that difference to make a fair comparison. Third, using the wrong discount rate can throw off your entire valuation. The discount rate isn't just a number. It should reflect the risk involved, inflation expectations, and the opportunity cost of capital. Picking an incorrect rate can misprice the value significantly. Fourth, focusing only on the size of the payments misses the bigger picture, the total cost. For example, when deciding on a mortgage, it's critical to look at the interest you'll pay over the entire term, not just a monthly payment. The bottom line is that good inputs lead to trustworthy answers. If you get the timing, rate, or compounding wrong, your valuation will be off. Always double-check these factors to ensure your time value of money analysis is solid. Now, Let's look at a practical example to help you understand how to apply what you've learned about mortgages. Maya is deciding between two loan options for her first home. One is a 30-year loan with an interest rate of 6.4%, and the other is a 15-year loan at 5.8%. The longer, 30-year loan means her monthly payments will be lower, which can be easier on her budget right now. However, the 15-year loan, while having higher monthly payments, significantly cuts down the total interest paid over the life of the loan. This example highlights a common trade-off. Do you prioritize a lower monthly payment today, or do you focus on paying less overall in the long run? By carefully comparing the size of each payment, the current cost, and the long-term financial impact, Maya can choose the mortgage that best fits her cash flow and aligns with her financial goals. This is the key decision point to keep in mind when selecting a mortgage. Let's review the key takeaways from this module. First, it's important to remember that money today is more valuable than the same amount in the future. This is a fundamental concept because mortgage pricing, payment structures, and investment returns all depend heavily on the timing of when cash is received or paid. Secondly, present value and future value are powerful tools that help us translate time into concrete financial decisions. By using these concepts, we can effectively compare loan offers, project investment growth, and evaluate long-term financing outcomes with much greater clarity. Lastly, the time value of money explains why factors like amortization schedules, interest rates, and payoff timing are so crucial. Over the life of a loan, the interest cost, equity buildup, and the overall value of real estate can change significantly as cash flows are spread out over time. Understanding these shifts helps us make smarter, more informed decisions. In this final module, we focus on using time wisely, because when you do, money naturally follows. Our goal is to apply present value, future value, and amortization concepts to confidently evaluate mortgage terms, compare different investments, and make smart real estate choices. First, we want to compare loan options not just by their face value, but by considering both interest rates and timing, to find which one actually costs the least over the long run. Next, practice is key. Work on calculating present and future values for a mortgage and an investment scenario to see these concepts in action. Finally, think about other factors like inflation, risk, or even an early payoff strategy, how these can influence your decisions and recommendations. By mastering these formulas and strategies, you'll turn complex mortgage loans and investments into clear, better informed financial decisions.